Hello class, welcome back to this QuickBooks online course, and we're going to kind of set you up for understanding the difference between cash basis and accrual basis. Because QuickBooks can be set up to run either way, it's important that we understand the difference. The accrual and the cash basis really has to do with the profit and loss statement. And the profit and loss statement is pretty straightforward. You take your revenues minus your expenses, and what's left is considered profit. But the difference between cash and accrual basis means that your profit is going to be different depending on which basis you use. The cash basis means that revenue is recognized, it's going to be counted when the cash comes in, and expenses when the cash goes out. So the cash basis basically follows the cash. And so it makes it a little bit simpler, but it doesn't quite as accurately portray the well-being of the business. Now, the accrual basis, the revenue is recognized at the time the work is completed or the product is provided. So if we were hired to do some landscaping, we would recognize the revenue when the work is completed, not when the customer pays us, but when the work is completed. And for the expense, it's the time the cost is incurred. So if we use the resource up, for example, we use up some supplies, that's when we would consider an expense. Not when we bought the supplies, not when we paid for the supplies, but more about when we used them up. Or when the service was provided for us. In other words, if we paid to have someone do our taxes, we would consider an expense at the time the taxes were done for us, not when we paid for the taxes. So the difference between accrual basis and cash basis is really about timing. So this is just an example. I'll walk you through it. And just again, remember, it's all about timing, not the total, but the timing. So let's say that we did some work for a customer, we did some landscaping, and then we sent the customer an invoice. And then the customer pays the invoice. So we did the work, and we invoiced the customer in January, but then the customer doesn't send us a check for the work until February. So either way, it's $450. The invoice is $450. The customer pays us $450. Either way, it's $450 total, but the timing's different. If we're using the cash basis, when the customer pays us, we call it revenue. But if we're using the accrual basis, we say, you know what, we did the work already for you in January, and so that's when the work is considered revenue. So let's look at a separate situation. What if the customer pays us? They prepay us for work they want us to do. So they prepay us to do some gardening. So they prepay us in January, but then we don't get to do the work until February. Well, if we're following the cash basis, we call that revenue at the time we receive the cash. We say the revenue came in January, and if we're using the accrual basis, we say, no, that's not revenue because we haven't done our part yet. It's not revenue until we do the work, and we don't call it revenue till February. Notice that the revenue ends up being the same, $775. But the timing of when the revenue is recognized is different in January and February. And that timing can be quite important, since when we look at a business's financial statements, we want to know the health and well-being of that business at certain periods of time. All right, let's look at some expenses. Now, let's say that we use up our utilities in January, and we get the bill, and we pay the bill in February. Well, the cash basis says, well, it's whenever we paid it, so we're going to consider the utility bill as an expense in February. But under the accrual basis, we say, well, when did we use those utilities? If we used them in January, the utility bill is in January, and we want to call that an expense in January. So again, it's a timing difference. It's going to have impact on the profit and loss in different months, but let's look at the difference. But we're not using the insurance all in 1 month. We're using it over 3 months. So that means if our insurance is $100 a month, then the expense is only going to be $100 each month. It's going to total up to $300 at the end, but the timing of when that expense is incurred is what's significant between cash and accrual basis. So in our final example, we ordered some grass seeds a while back, and we've never paid the vendor for the grass seeds, but we're using them. So we ordered the grass seeds, they came in, we're using them. We used some of the grass seeds in January, some in February, and some in March. And so under the accrual basis, when we use those grass seeds is when we have an expense. Using up the grass seeds is using up a resource, means that that is when the expense occurs. But if we're using the cash basis, we say, it's really about when we paid the vendor. Since we never got around to paying the vendor, maybe we forgot, or maybe we were holding out for some other reason, but we never paid the vendor until March, and so that is when the expense occurred under the cash basis. Even though the same amount is going to get paid, it's just a matter of what period we put that amount with. Notice the total expenses add up to $555, whether we're accrual or cash basis, because in the long run, the cash and accrual basis are probably going to be the same, assuming that everybody's paying what they owe. Notice the cash basis impacted profit. That's going to total $220. That's taking the revenues and the expenses, and we see that it's just hitting different months differently. So notice that some months are higher and some months are lower than the accrual basis. But when we look at the long-term impact, it's still $220. So QuickBooks Online has the ability for us to set up our business or our client's business to be cash basis or accrual basis.